In the dying days of the Trump administration, Jeremy warned U.S. stocks are in a bubble of epic proportions. Now he worries more stimulus to fight the COVID-19 pandemic will only inflate the bubble further, and no amount of Fed liquidity can stop it from bursting.
This is a monetary game, and you can keep these little monetary bubbles going for just so long as you keep confidence rising. But when confidence has reached these levels, the history books are pretty clear. It's very difficult to increase your enthusiasm from a state of mild hysteria where we are.
So Jeremy's talking about the bubble that the economy is currently in, and at the time of his interview, he was talking about the stimulus that was still in conversations, which has now been approved as of my recording of this. And he's afraid that as we continue to put more and more stimulus and the hype around the economy continues to go, we're going to face another crash. Now, if we're really unfortunate, and if you listen to all of the critics out there, we are in a bubble, and it might pop at any time, and no one knows when or for how long it'll happen. The last few weeks, of course, have been fairly red, and the economy has been pulling back. But is that trend going to continue? Are we going to see it go back up? No one really knows at this point, and all we can hope for is that it's not long-term like it was back in the Depression, when it took years and years for it to recover to get back to a level that we as a society are comfortable with. Of course, there will always be bubbles. There will always be something that makes the economy go up or go down, the latest craze. Right now, we're in a tech craze. Everyone is overvaluing tech, and they're worth so much more than they have been historically. Some of the most recent ones would, of course, be the collapse of the economy from the dot-com crash or the real estate bubble that popped. And we can only hope that these things do not continue, or that they don't last for a long period of time. So we want to make sure that we're protecting our portfolio. And how do we do that? How do we make sure that our portfolio stays safe, that the companies that we purchase are going to continue to make us money or pay us dividends in the long term?
It's really simple. It's subscriptions, 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 and a little bit more of subscriptions. That's where all the money seems to be these days. Everyone's growing that income every single month by buying every single month. They make you purchase every month. It could be a contract like you do when you get a phone plan with Verizon, or hey, they bring the food right to your house, nice and easy. You just pay a little bit extra, but you get convenience.
Netflix is a perfect example. As you can see, year over year, their subscriber base has increased. It's been slow and steady, but as those subscribers are always increasing, so does their revenue. If we flip down here to their revenue stats, you can see as the subscribers increased, so did the revenue. It's really simple. The best part for Netflix is they don't need to do anything extra once they have acquired that subscriber. They, of course, need to maintain their output and quality of their content, but they get that income every single month when you or I pay our subscription. They don't have to wait for the next big blockbuster. They get a little bit of money. So if it's a quieter month and there isn't a new blockbuster movie coming out, they still get that income. And it's consistent. It's at a low enough price that people like myself or you will pay for Netflix every month. And we might not remember about it, so we might pay for it once or twice, didn't use it, but we'll still come back, and they keep getting that money, and it's consistent for them. And they get to use it to reinvest back into their company, or if they want to pay a dividend or any other way that they want. But it keeps their finances stable, and they're not as much at the risk of something bad happening. So if they have one flop, they're not going to lose out a lot of money. They're going to continue to get that income.
Everyone's heard of Apple and Microsoft. You know Apple as the phone maker or the iPod maker. That's where they got their start. They were waiting for you to buy the next iPod or the next phone for them to get that next injection of money. Now they've moved into subscription-based. Look at all of these different services that they offer, and they have tons of different plans, and they give you great value for your money. You know, for $15 a month, you get music, TV, arcade, iCloud, or if you go all the way up to the premier version for almost $30 a month, you get all of the same things, but you now get 2 terabytes of iCloud. You get news. You also get fitness. The benefits are endless, and they always have that consistent revenue, so they can continue to build their company, and they get to continue to invest more and more money into their dividends if they so choose. Microsoft, same thing. Every couple of years you have to spend another $100 or so, buy the whole new Microsoft suite. Now, instead of doing that, they offer you a month-by-month subscription. You can get it for just yourself, your business. And it actually saves them money in the long term because they're not having to maintain all of those different versions of Microsoft and Excel. They get to just focus on one product. It's all online. It's all in the cloud. You don't have to buy a physical copy. And it's simple. And it's convenient for the consumer because, again, you get all of these products all at once. They're always up to date. So it's really convenient.
One more great example that I want to highlight for you today is Disney. Of course, everyone thinks of Disney, you think of their fantastic movies and their amazing parks that they have all around the world. And if you look to right before COVID hit, they were trending at all-time highs, so in and around that $130 range. And this was strictly based off of their movie launches and their parks. They were consistent. They didn't really go up. They didn't really go down. They slowly go up with inflation. And of course, with COVID, they dropped drastically. They lost majority of the revenue. Movie theaters closed. People weren't going to go watch the latest blockbuster movie. Disney, like everyone else, made that hard choice during the pandemic, and they made a huge pivot. And they've been growing Disney Plus very aggressively over the last few months. And as you can see, by August, when the first kind of wave of restrictions were lifted, they were basically back at their all-time high. How did Disney do that? It's really simple. They have a subscription-based service. They're making a huge amount of money every single month from Disney Plus, and they're going to continue to go up every time there is a new announcement for Disney Plus. They're putting out a new TV show, The Mandalorian, putting out the latest Avengers movie like WandaVision. They get this huge bump, and they continue every month. You see them, they're slowly rising. Just in the last 1 year, they have increased 82%. So they've gone up $85 or 82%. They're at all-time highs right now. They're at almost $190 for one single share. Disney is continuing to be a household name. That's never going to change. But as they continue to grow their subscription service, they're going to be a huge competitor with other companies like Netflix. Plus, once they're able to fully reopen all of their parks, that original stream of revenue is going to launch them into a whole new level. And they're not as dependent anymore on those movies, like I mentioned earlier, or their parks. They get consistent money every single month now from Disney Plus, and of course, as they continue to grow that, they're just going to keep doing better and better. So I could sit here and continue to give you examples of companies over and over again that have been changing to a subscription service, or that do a subscription or contract-based payment, so they have that consistent income. But I think you get the point. If you want to be a budget investor like myself, you need that stability. You need companies to continue to go up. You want companies to continue to pay you dividends. You want your passive income to continue to grow. A subscription or a contract for a company is going to be what gets you there. As you can see, as I've been adding more and more money into my portfolio, my dividends have been increasing. Only the 8th right now when I'm recording this, so I haven't gotten all of the dividends in yet for this month, and I've already passed pretty much every single month in 2020 as I've put more money into it. My passive income stream is going to continue to grow. I'm going to make more money. I know $12 so far in March isn't a lot of money, but that's $12 more that I get to put into another stock. So because of this, my budget investing is going to be stable. These companies won't have huge fluctuations up. They're not going to have huge fluctuations down, but there will be consistent. They'll pay me a quarterly dividend, maybe even a monthly dividend, but I get to use that money that they give me extra, or if they do continue to grow, and I get to, profit from that in the long run. It's beneficial, it's safe. I remove a lot of that risk for myself. So thank you so much for tuning in today. I really appreciate it. Please make sure that you do subscribe, thumbs up, and comment. Or anything else that you'd like to hear or see and learn about, I'd love to share that information with you. Otherwise, thanks so much, and I will see you on the next video.